Bank stress doesn't usually look like a movie. It rarely starts with a dramatic collapse. It starts with confidence weakening. And once confidence weakens, credit events can spread faster than fundamentals. A credit event is any moment when lenders suddenly reassess risk. A bank fails. A major borrower defaults. A funding market tightens. A large institution reports losses. The details vary, but the mechanism is similar. Risk gets repriced, liquidity becomes selective, and the system starts tightening from the inside. The first way credit stress spreads is deposit behavior. Banks don't function like normal companies. They rely on trust. Deposits are short-term funding. Loans are long-term assets. That mismatch is manageable when people believe their money is safe. But when confidence drops, depositors move fast. Not because they're irrational, because they can. In a digital system, money can leave in minutes. When deposits leave, banks must replace funding. They raise rates to retain deposits, which hurts profitability. Or they borrow in wholesale funding markets, which can become expensive during stress. Or they sell assets to raise cash. And that's where the next layer begins. The second spread mechanism is asset sales. Banks hold large portfolios of bonds and loans. When funding tightens, they may need liquidity. So they sell assets. But selling assets in a stressed market can lock in losses. If interest rates rose recently, bond prices fall. So a bank selling bonds might realize losses that were previously hidden on paper. Those realized losses reduce capital. Lower capital reduces resilience. And lower resilience weakens confidence further. This becomes a feedback loop. Confidence drops, gives deposits leave, gives assets sold, gives losses realized, gives confidence drops again. The third spread mechanism is lending standards. Banks respond to stress by becoming conservative. They tighten credit. They reduce risk exposure. They demand more collateral. They increase loan pricing. This is rational for banks. But it tightens conditions for everyone else. Small businesses can't refinance. Households face higher borrowing costs. Commercial real estate struggles to roll loans. Corporate expansion slows. Even if the economy was stable, tighter credit can slow it. This is how bank stress becomes real economy stress. And it often happens quietly. Not through a collapse, but through credit contraction. There's also a market layer. When investors see banking risk rising, they reprice risk across other assets. Bank equities fall. Credit spreads widen. Funding costs rise. And risk-off behavior spreads. This is where contagion emerges. Not because every bank is weak, but because nobody wants to be the last person holding risk. When uncertainty is high, investors prefer safety. So money flows toward government bonds and cash-like assets. That drains risk liquidity. And liquidity is what keeps markets stable. Now, what makes a credit event spread versus remain contained? Three things. First, concentration. If many institutions hold similar exposures like commercial real estate loans, long-duration bonds, or certain regional assets, stress spreads faster. Second, speed. In modern markets, information travels instantly, so reactions happen faster than regulators can respond. Third, policy credibility. If markets believe policymakers can contain stress, panic fades. If markets doubt containment, stress persists. This is why central banks and governments focus so heavily on messaging during crises. They're not only providing tools, they're stabilizing expectations. So what should you watch for early signs? 1. Unusually fast deposit shifts or reports of deposit outflows. 2. Sudden spikes in funding costs in short-term markets. 3. Widening credit spreads, especially for banks and high-yield borrowers. 4. Tightening lending standards in surveys and corporate credit conditions. These signals often show up before broader economic data turns, because credit systems move first, and the economy follows. The big idea is this: banks are the transmission system of the economy. When banks become cautious, credit slows. When credit slows, investment slows. When investment slows, growth slows. A credit event doesn't need to become a full crisis to matter. It only needs to make banks tighten. That tightening is often the real damage. So bank stress isn't just a banking story, it's a macro story. It's a confidence story, and it's a credit story. Because when credit becomes scarce, the economy feels it long before the headlines call it a recession.